Hello and welcome. So you're looking to build up that passive income stream with some solid Aussie dividend stocks, right? It's a classic goal for so many investors on the ASX. But what if the most common way of finding them is actually a massive trap? Well, that's exactly what we're going to break down today. Let's get into it. I'm going to guess that if you're here, the answer is a huge yes. I mean, who isn't? You've seen those big, juicy-looking dividend yields, and you've probably thought, yep, that's what I need in my portfolio. It's an incredibly tempting path, and you are for sure not alone. But what if I told you that chasing that big number could be a really costly mistake? Wow, that's a pretty heavy statement, isn't it? It really gets to the heart of a critical mistake that so many investors make, especially when they're starting out. Chasing that big percentage, that super high yield, it feels like a sure thing. But as we're about to see, it can lead you straight into a pretty nasty trap. So let's talk about the hunt itself. High yields are so alluring. I get it. They promise a steady paycheck, a little cash deposit from your investments hitting your bank account. But they can also be a massive warning sign, a red flag that something's not quite right under the hood. Okay, just a super quick refresher. The dividend yield is just the company's annual dividend divided by its current share price. It's a really simple snapshot in time. If a stock is $10 and it pays a $1 dividend, the yield is 10%. Easy math. But that number tells you absolutely nothing about why the yield is 10%, or if that payout is even remotely safe. So, what is a high yield really telling you? Well, you got to remember, the market isn't stupid. A huge yield that similar companies don't have is often the market's way of telling you there's risk involved. It could mean the share price has been tanking, which mathematically pushes the yield up. It could mean the business has basically stopped growing, or it might just be a one-off special dividend that you're never going to see again. And all of this leads us right to the main event, the core danger we're talking about today, the dividend trap. This is, without a doubt, the number one reason why blindly chasing a high yield can absolutely wreck your portfolio. So what exactly is a dividend trap? It's when you buy a stock because that yield looks so good, but the company can't actually afford to keep paying it. And what happens next is a total disaster. The company is forced to cut the dividend, and all the investors who were only there for that income, they sell the stock and the share price just plummets. You get hit with a double whammy, less income and a big loss on your investment. Ouch. This is probably my favorite way to think about this whole problem. Getting paid from a business that's slowly shrinking, well, it's like trying to collect water from a melting ice cube. Yeah, sure, you're getting something right now, but the actual source of your income is literally disappearing before your eyes. And in the end, you're just left with a puddle and nothing to show for it. Let's look at a real-life example right here on the ASX. WAM Capital is a really popular investment company, and it's known for its high payouts. Now, on the surface, a 9.45% yield looks absolutely incredible, right? But when you start digging, you see the profit reserve. That's the pot of money they use to pay dividends. Only has enough cash for about 18 more months of payments at this rate. And then you look at the share price, down over 20% in 4 years. That's a classic sign that capital is being eaten away just to fund that dividend. It's the melting ice cube in action. And here's another kind of trap to watch out for. A company like Woodside Energy might have a huge yield today, but it's what we call a cyclical business. Its ability to pay you is almost entirely dependent on the price of oil. When oil prices are high, things are great. But if oil prices fall, and they always do, they're super volatile, that dividend could shrink or just vanish overnight. That's not the reliable income you're looking for long term. Okay, so if chasing yield is so dangerous, what should we be focusing on instead? The answer, my friends, is a much more powerful metric for long-term success: total return. This is the real game changer. It's about shifting your mindset from just income to building real wealth. And this lays it out perfectly. The dividend yield, that's just about the cash you get in your pocket today. But total return, that combines your dividend income with the growth in the share price itself. It is the complete picture. It's not just about getting paid. It's about owning a piece of a business that is actually growing in value over time. That's how you build wealth. Check this out. It's a classic example. For years, AT&T was a high-yield favorite, but the business itself was struggling, so its total return was, well, just okay. Now, compare that to a company like Lowe's. It had a more modest dividend, but it was a quality business that just kept growing. The result? A way better total return. This just proves the power of focusing on quality over a flashy starting yield.
So how do we actually find these healthier, sustainable dividend payers and, avoid all those traps? Well, let's open up the Smart Investors Toolkit. I'm going to show you the key metrics you absolutely need to check.
All right, the single most important number for dividend safety is the dividend cover ratio. It's a simple idea. How many times can the company's profits for the year cover its total dividend payments? A high number means the dividend is super safe. A low number is a serious red flag. Think of it as your ultimate dividend safety check.
So what number are we looking for? Well, a really good rule of thumb is a dividend cover ratio of at least 1.5 times, or even higher. What that means is the company's earnings are 50% more than what it needs to pay out the dividend. This gives it a really healthy safety buffer just in case profits dip for a year or two.
So here it is, your simple, actionable checklist. Number 1, look at the yield. Does it seem a little too good to be true? Because it probably is. Number 2, check that dividend cover ratio. Is it above our 1.5 times safety line? And number 3, do a quick health check on the business itself. Are profits stable or growing? Is the company drowning in debt? This simple 3-step check can save you a world of pain.
Okay, let's put our new toolkit to the test. We're going to do a head-to-head comparison right here on the ASX, putting a potential trap up against what looks like a much more sustainable dividend pair. Let's see how they stack up.
All right, check this out. On the left, we've got WAM Capital again, with its huge 9.45% yield, but a dividend cover that's dangerously low. Now on the right, we have Evolution Mining. Its yield is a much more modest 1.92%, but look at that dividend cover, a rock-solid 2.83 times. That tells you its dividend is incredibly safe, and it's being paid for by strong, real cash flows. Seriously, which one of these would you rather own for the next 10 years?
And this brings us to the most crucial point of all. The dividend is not the prize. The dividend is just a consequence of owning a fantastic business. So stop chasing the yield. Stop chasing the number. Start chasing the quality of the company that's actually generating that cash in the first place.
So, I want to leave you with one final, really powerful question to ask yourself before you ever buy a stock for its dividend. Just imagine, if the company announced tomorrow that it was canceling its dividend so it could reinvest that money back into growing the business, would you still be happy to own it? If the answer is no, you might be walking straight into a dividend trap. Thanks for tuning in.